So your sales were up last month. So why is there less money in your account than the month before? This is the cash flow trap, or let's say the timing gap, and it catches store owners who are doing everything right. Today, I'm going to show you exactly why it happens and what to do about it. So let me paint you a picture. This month's sales are up 20%. New customers are walking in. Your team is working very hard and you're busier than ever before. But your bank account, supplier invoice just landed, rent comes out Friday, card processing fees hit this week, and somehow you have less cash than last month. This is the cash flow trap, and it catches owners who are doing everything right because the problem isn't your sales, it's the timing. This isn't bad luck, it's cash flow timing problem. And once you understand it, you can fix it. So here's the distinction that changes everything. Profit is what you made on paper. It is your revenue minus all your costs. It shows up on your income statement. If you sold 8,000 of stock that cost you 5,500 to buy, your profit is 25 on paper. Cash flow, on the other hand, is what's actually in your bank account. It's about when the money comes in versus when the money goes out. And the timing is everything. So here's the problem. You might be profitable on paper, but if your supplier wants paying on Wednesday and your biggest sales day is Saturday, you have a gap. And that gap can overdraw your account even when your business is genuinely doing well. So profit tells you where you ended. Cash flow tells you whether you can survive the journey. So what are the specific things that drains your cash without warning? I see 5 consistently. And number one, paying suppliers before you get paid. Stock goes out the door, but cash comes in later. The gap between those two events is where the pain lies. Number 2, overstocking slow moving items. Cash sitting on your shelf is not cash in your pocket. Dead stock is one of the quietest cash killer in retail. The number 3, seasonal dips that you didn't plan for. January after Christmas, the post-summer slump. These are predictable, but only if you're tracking them and planning ahead. Number 4, unexpected large expenses, equipment breaks down, an emergency repair, a surprise bill. If you have no buffer, any one of this becomes an instant crisis. And number 5, growing too fast without enough reserve. More sales means more stock needed. More stock means more cash tied up before sales convert into money in your account. Don't get me wrong, growth is good, but unplanned growth is dangerous. Growth consumes cash before it produces cash. So most businesses discover cash problem when it's already late. A 13-week projection gives you time to react. The single most powerful thing you can do for your cash flow is to build a 13-week projection. And here's why 13 weeks specifically. It's 1 quarter. It's long enough to see problem coming. And it's short that your numbers are actually accurate. With a 13-week cash flow projection, you can see cash gaps before they happen, 4 to 6 weeks in advance, not the night before. You can plan your stocks around your cash position. You can model hiring decisions before you commit, and you can build and protect a minimum cash buffer. I know that this may sound impossible at first, and that's normal. But this isn't complicated accounting. It's a weekly snapshot of money in versus money out, and it changes how you run your business. So, 5 questions. Please go grab a pen. Pause this video and calculate this right now. Most owners have never done this exercise. So one, how much cash is in your account right now? Write that number down. Two, what bills are coming due in the next 14 days? Supplier rent, wages, any auto pay charges. Total them up. Then three, what sales do you realistically expect in the next 14 days? Be honest. Use last month or last year as your guide if needed. Then four, subtract your bills from your expected sales. Then add your current bank account balance to it. Is the number positive? If it's negative, you have a gap to close right now, not in 2 weeks. So number five, do you have 4 weeks of operating costs sitting as reserve? If not, that is your most important financial goal right now. Not growth, not new products, but building that buffer. So let me show you what this looks like in real numbers. This is a grocery store with solid sales between 4,000 and 5,000 a week coming in. On the surface, doing well. Week one, 4,200 came in, 2,000 out. The net positive of 1,400. The bank balance at 3,900 is good. Then week two, 4,500 comes in, but 5,200 goes out. Supplier payment and rent land in the same week. Net negative of 700. The bank balance that was 3,900 before would drop to 3,200. All right. Week three recovers. Strong week, over 2,000 net positive. But then week four, 4,800 comes in. 6,400 goes out. Another heavy payment week. Net negative of 1,600. Balance would be back down to 3,600. You see the pattern? Week two and week four are always the hard week. Supplier and rent landing together. With a 13-week projection, you see this coming 4 to 6 weeks out and you reorder differently. Without it, you'll be surprised every time. So there are 3 rules to live by. Rule 1, never run below 4 weeks of reserve, 4 weeks of operating costs sitting untouched. This is your emergency buffer. Build it before you invest in anything else. Rule number 2, match your stock order to your cash flow. Never reorder on habit. Reorder based on what your projections tells you can afford that week. Then rule number 3, project 13 weeks and review it every month. 30 minutes a month updating your projections. The projections only work if you keep it current. The Margini Growth Pack is a spreadsheet system designed for store owners who are ready to plan ahead. It is $29.99. It's a one-time purchase, works great on Excel, limited use on Google Sheets. It includes a 13-week cash flow projection. See your cash position week by week, 3 months out. It also has a scenario planner. You can model what would happen if you hire someone or you take on a new supplier before you commit. Weekly and monthly views, and there is also plain English inside that tells you what your numbers mean, not just what they are. You don't need a finance degree, you don't need to be a CPA. They're clear numbers and just a plan. So most small businesses don't fail because sales are bad. They fail because cash runs out unexpectedly. If you can manage cash flow, you give your business time to survive, to adapt and grow. Profit and cash flow are not the same thing. You can be profitable and still run out of cash. And now you know exactly why. The 5 things that drain your cash flow: paying suppliers before you're paid, dead stock, seasonal dips, unexpected expenses, and growing without a reserve. The fix: a 13-week projection, a 4 to 6 weeks buffer. Store orders match to your actual cash position. Do the 5-question health check. It takes about 10 minutes. Then next week, we're going to be talking about costs that silently eat your margin every week. The ones that don't show up in your daily summary, but are costing most store owners thousands a year. Thank you so much for watching this. Please always consult your CPA or your accountant for your own specific situation. And see you again next week. Bye for now.